Patrick says, I made a mistake, too much risk to start. It's a, let's see here, I apologize. The married put position and collared with too little premium for the call and too much premium. Still expect Apple to increase. Okay, so we have a married put on Apple that was converted to a collar. Apple 100 at 129.65. Oh, not covered call. I'm going to go to custom spreads. My apologies. AAPL. So we have Apple. And you said the cost basis here is 129.65, Patrick. Yes, I was saying, but the effective cost per share is 125.95. That is great. Okay, great. So for further adjustments, you've got a cost basis on your Apple position, 125. We've got a July 16th, 130 put. Okay, and you originally paid, I'm just going to take a look at this. I know you've made adjustments here. And your price on this was $15.05, it looks like. Okay, great. Not too bad at all. Yes, that put looks expensive. It's lost in price, Patrick, because the stock has moved up, as you and I talked about, I believe, in our emails earlier. I'm sorry, no, that wasn't, I don't believe that. I'm sorry, my apologies. In any case, this isn't a bad risk at all. 7.8% to start. I know it was higher, but you've lowered it with the cost basis. It was at 129, so you've got 4 points off. This would have been $1,500, maybe closer to that 10% that we mentioned earlier. But now you've sold a May 21st, 135 at 150. Great. So that took, okay. It's all right. Let's take a look here. Yeah, okay. So here's the deal with this. Following the rules in the blueprint, of course, and what I'm talking about, let me just go back here. We're going to go right back to that in a moment. Following the rules in the blueprint to discuss is our approach, of course, for the married put technique with the proper limited risk on the position and using the 12 different income methods. The issue Patrick is kind of facing here is that normally what we look for when doing this income method number one, the most obvious one when you have a married put, hey, let's go ahead and sell a call against the position, generate some premium. Well, the original risk with your effective cost per share, well, your original risk, Patrick, was much higher, I understand. But the lowered risk we had was about $1,100 or 7.8%. One of the main rules for income method number one, you of course followed correctly, and that's you always sell a call above the put strike price, at or above the put strike price, and you did that. Why do we do that? Is because if I did it the opposite way, I'd create a bearish position where I could lose to the upside in the direction I thought the stock was going to go. The blueprint spells all the rules for each income method, how to use them, and how to manage those once you're in those positions as well. Okay. All right. Now, what we usually like to do, and what we discuss is a good idea, and why you don't want to get too little premium, is we don't want to see this negative. We want to see this in the positive and sort of trailing off lower. And it's always going to trail off in this case. We'll explain that in a moment. But with this type of calendar collar that we create, we want that slope off, but we want this in the profitability. We want it in a profit zone. And that's why in the blueprint, you see the suggestion. You know, we talk about this in free webinars, so I'll talk about it now. But one of the other guidelines, in addition to selling a call at or above the put strike price, you don't accidentally get set in a bearish position, is that you want to collect at least a third to a half of the initial or existing at risk with this income method. That would give me a better risk reduction naturally, and it would push this up into the profitability. And that's why the guideline is there. Right now, we're in an okay situation, believe it or not. This doesn't look attractive. No offense, Patrick. It's just there's nowhere to profit on this right now. But let's look at what we have committed to doing already. You sold a 135 call that's going to expire in 21 days at 150. Right now, the buyback cost in this option, what I saw in the bid ask when we added it, was 147 to 152. So you have no gain in this position to help the cost basis, help the risk, or if you buy it back now, you're just going to be adding to the cost basis. Don't want to do that. If the stock starts to creep up and it starts going up to 134, 134.50, then you'd maybe consider buying to close this just to get out of the way and to let it move up. But for right now, with the stock staying below that threat, unless it gaps up on Monday, and that's a risk you're already in because you haven't closed it, Patrick, I'd say the plan here is to try to get some of this time decay in your favor. Hold it for as long as you can because you committed to this call. And there's not going to be a better call to sell right now. You could buy it back and sell the 130, but that would be in the money. And I don't think that would give you the profitability that you're looking for either in this case, because it's at 131. And your sentiment is that it's going to move up. I'd want to see some time decay on this, Patrick, before buying it back personally. If this was in my position, I committed to this. Maybe I made a mistake. I'm not even going to say it's a mistake. We would have liked to have done something different, something better. But you committed to selling the call and you collected $1.50. To make sense to move or adjust it right now, we want to see some of this decay in your favor so you can buy it back cheaply, help reduce some of that risk, and then we can evaluate other income methods following the rules in the blueprint that might set you up for a higher profit. Why not? Okay, someone says, well, can we see what would happen if he rolled down to the 130? Right, but we don't want to sell a call that's in the money. But let's see if there's other strikes. So let's go in and simulate buying back this call here at 135. There are 132s, 133s. All right, so I buy this back and I pay almost the exact same price that we collected, and you can get another 60 cents going to the 130. Okay, so what's that doing to the position right now? Well, number one, it actually sets you up closer to the current stock price. And remember, Patrick's sentiment is that he's bullish. Still doesn't put us into profitability, does reduce the risk further. But again, now we're very close to the vest with a 133 strike call in this position with the stock at 131.46. Patrick's got $3 or $4 to play with up to 135. Want to see some time decay on that option to buy it back cheaper to help with the risk reduction and then go from there. Now, Patrick, of course, starting next week, if you think Apple's really going to run or the market's really going to run, yes, you may want to buy it back, just leave it open, even though that might be a higher cost basis of 5 cents, 10 cents or so. And then you can wait for a better opportunity. And depending on what we want to do with this position as well, Patrick, what I mean by what you want to do, Patrick, is that if you're planning on doing this long term, as always, if you start to get within 60 days, 45 days of July expiration, you're going to want to consider rolling this 130 put out further as well. Okay. Let me clear these two out. This was a similar discussion that we had last week from Mark, I believe. Mark had a question, well, if I have an income method number one in place, and I feel that yours isn't, but he was afraid that his short call was going to be threatened, that the stock was moving up above that price, Patrick. And he said, can I use income method number 4 in the blueprint to help with the effect of this call going in the money? What is 4? It's rolling up the put. Rolling up the put is done at a debit, but it reduces the maximum risk more on the position than most other income methods, depending on what premium you can get for selling a call for income method number 1, or premiums you might get for one of the riskless spread trades that's done in the Married Put construct. But what it would do in this case is exactly what we saw last week. I could roll the 130 put up to the 135, but that's going to increase the debit. The risk is going to lower, but this is going to go lower as well, because increased debit means less higher profitability. That's what we're going to miss out on in that case. So 4 is not a way to manage 1 as it starts to go to the strike price of your call or above it. Once it starts doing that, you want to manage the call first, then evaluate what you're doing with the put. Okay. But Patrick, I think now that we've committed to this and you're in this trade, you want to go ahead and get that premium there at 150. See some of that decay in your favor in that case as well. All right, fantastic. So yeah, let's wait for see some decay there, but if it does start to move, Patrick, you want to address that. And this sometimes is posed to me during a webinar as a different question. And the different question is, if there's only one strategy you could trade for the rest of your life, what would it be? And that to me is a similar loaded question. And why I say that, Domenico, is because what you're saying to me is that if I could only enter one type of trade for the rest of my life, meaning that I could not do any adjustments, I wouldn't be available. I'd have to fill my portfolio out, and then I get something bad happens. I'm in the hospital for 8 to 10 months as well. My answer is the Married Put. Okay? Every time this question is asked, it's the Married Put. Why? Because if I entered positions here, long-term growth stocks, controlled risk for stuff happens, of a risk of only 5 or 6%, and I can't be there. I can't be there to do the income methods, true. I can't be there to do adjustments. But if I'm gone for 2 years, and I use 2-year out leaps, Domenico, with the Married Put approach that we use, I don't normally go that far, but I'm saying if I did, what do I know? I know that whatever I have in that portfolio, that if something tragic does happen and would go to my wife, go to my kids, or something along those lines, whatever I started out with is probably not down by more than 5 or 6%, no matter what the market did. And if it goes up, I still have unlimited upside. Now, I like using the income methods and I like adjusting it. That's my answer. And if I'm looking at it, I'll say it this way, Domenico, if I'm looking at it in the light of my favorite strategy, means what is the strategy I'm probably going to be trading for the rest of my life as a trader as I keep trading, a Married Put is always going to be in my portfolio somewhere. I can guarantee it. So you'd likely say that's my favorite. Eric says covered calls, delta of 40. So he's taking a hedge protection approach, but he's using stocks, but using an out-of-the-money call, slightly out of the money, Eric, lightly, as the hedge, which caps the upside. I'm capping the loss to the downside, paying a premium to do that, but leaving the upside open. If I could only do one thing and was not able to do adjustments, was impaired of doing adjustments in that fashion, it would be the Married Put. And I do not do, Ernie and I do not do synthetic Married Puts where we do the synthetic long stock and the put as well. You said if someone doesn't have enough money, would a synthetic be idea? Ernie and I don't do that. We don't use that structure, Domenico. It's up to the individual investor if you want to try that to save money on the position. Okay, and in that case. But my answer every time that this question is asked is going to be, of course, the Married Put approach. Okay. Oh, you can see that right here. Very quick, Eric. Okay, and one further comment on that. One further comment on that for Domenico. Right now, my favorite strategy, my favorite fun strategy that I've been really enjoying, and I don't want to say I've been lucky with, but it's given me a lot of information, a lot of structure, is actually those weekly bull puts. But if you're posing me a question, if there's only one strategy that I can trade for the rest of my life, meaning I can't be here to do adjustments, I'm impaired in some way or fashion, it is definitely not the bull put spreads. They have to be actively managed. You have to not take a loss of more than 50% of your original expected loss in the position. You can't let it go to the maximum loss. They have to be managed. They have to be adjusted. If I'm putting on trades for growth in the portfolio, for growing the portfolio for the kids for the future and everything along those lines, I'm not going to be able to make adjustments. It's going to be a Married Put every time. Okay. Eric, you said what in the blueprint, we talk about our full approach. This blueprint product here is all electronic. We don't send out a hard copy now. But Eric, the blueprint is the one that discusses the structure that we use for the Married Put. And it's kind of shown right here in the search. We don't go more than 20% in the money. We're looking for particular stocks. You can change the price range as well. And we want to keep risk to single digits. And everyone says, well, why don't you use Delta? Because I am using Delta. But I'm not. I'm not searching for Delta. I don't look at Delta when using the structure. But I'm just going to show this real quick. We're going to add Delta, Eric, into the list. Without even having a Delta filter. Let's go back down to the bottom here. Where's my Delta? There it is. Not even using a Delta filter. All of my Deltas on the first page. Yeah, I do have 2 pages, but they're all going to be the same on the next page. Look at those numbers. 0.61 to 0.48. This looks like my low at 0.48. 0.61 looks like, oh, I'm sorry, there is a 0.75. That's an outlier. Investors Bank Corp, 17.5, 0.75 Delta, the risk of 5.1%. Yeah. Okay, so that's the outlier. Normally, when I pull up the search, Eric, this is the range you see, about 0.65 to 0.5. That's a pretty restricted Delta without even using Delta. How is that working? Well, because, yeah, we're using percentage. The percentage risk is controlling it. We're also using other criteria where we are not seeing stocks that you're not seeing stocks that are fly-by-night, high implied volatility, things with outrageous volatility where the risk is too high. They're getting filtered out because of the risk, Eric, as well. So you're absolutely right. I'm filtering by Delta, even though that I'm not. But it's always the same. Every time we run this, we show that we're filtering by Delta because of the other criteria. Everything eventually works hand in hand. And Eric, yeah, Eric says, yeah, fundamentally safe, but also some volatility. Okay, we want to see growth companies. We want to see movement for the Married Put approach. It's not all. I usually have 1 or 2 Married Puts in my portfolio that are on a dividend-paying stock. You see Exxon in here. But normally it's not a great idea to have Married Puts on extreme blue chip stocks that pay a high dividend and have no volatility. You want more movement in that. That's why we're seeing things like I mentioned is DR Horton, Ally Financials and Married Put we got into recently. Applied Materials, good quality stocks, as you mentioned, AT&T, right? Good quality stocks that you mentioned, Eric, but with movement. That also helps with the income methods, selling the calls, doing the spreads, getting the premium. You want some movement in there.